Hello, everybody. Welcome back to Talk Capital. My name is Gev. It's Tuesday, May 26th, so let's talk capital. All right, I hope everybody enjoyed their long weekend. That was nice. We got a nice 3 day break from everything. Got to spend some time with the family, do a little barbecue, have a little bit of fun. So I hope everybody enjoyed that. But it's time to get back to work, guys. And I want to apologize for not making a video over the weekend. I know I said I would, just got a little crazy over the weekend. Everybody was over at the house having a good time swimming and everything. So, like I said, we took a little break. It's cool. We get right back into it today. I'm gonna promise you guys a video every day this week. So Tuesday, Wednesday, Thursday, Friday, possibly even Saturday. We're gonna have a crazy week in the markets this week. A lot of news is coming out. Also, markets are hitting very crucial numbers here, as I'm about to show you guys. So we're about to have swings in either direction. We're either about to go very bullish or very bearish in this next week, in the next coming days, realistically. Okay, so to start off with a couple nuggets and news here, you guys already know unemployment is coming on Wednesday or Thursday this week. I'm not going to go over that until we get the numbers. But what I do want to go over is this right here. So I found this nifty little chart someone put up on Twitter, and they're pretty much this is taking into account the number in trillions of dollars that we've pumped into the markets in stimulus and how much of a GDP that is for each um, basically each zone of the financial world, right? So we have the US, which is like the western zone, you have the eurozone, you have Japan, UK, China, and then the others are like the smaller ones. I mean, I don't want to say irrelevant, I don't want to hurt people's feelings, but these are countries that basically, as you can see, the GDP number isn't even here, is because it's so tiny. It's minuscule, really irrelevant, right? But what we do want to take into account is this. So central bank potential liquidity injection. What this is saying, what central bank potential liquidity injection is this is basically a central bank vouching to step in if required to provide liquidity, and also providing liquidity at the moment. So what that is say you're running out of money, the central bank steps in and provides liquidity for you to continue your operations. Money crunch, they step in, they provide you liquidity, right? So as far as we stand today, the United States, we're at 6.2 trillion in liquidity provided by the Fed, which is absolutely insane. That's 29% of our GDP. What I want you guys to understand is, I was talking about this in a video about a week ago, if I'm not wrong, but 29% of GDP, that's 1 year's GDP, guys. That's 1 year GDP. That's what we've already pumped in, is 1 year's worth of GDP into the market. I'm sorry, 29% of 1 year's GDP into the market. And that's just in liquidity, right? As you guys can see, we're definitely leading the way. I mean, it's to be expected, right? I'm honestly surprised China's not doing more, but I mean, this might be because their hands are tied through all the sanctions and this and that, and it's something I'm about to get into. Now, government fiscal stimulus. United States is at 3.3 trillion. This is all the small business loans, your $1,200 check if you got one, hopefully you did, and all those small little things. That's the government fiscal stimulus. That's 15% of our GDP. Okay, now combined, guys, it's important. These numbers are combined. This is freshly minted dollars. These are freshly printed. These numbers need to be combined, right? This is what we're talking about. 9.5 trillion with a T, not with a B, not with an M. That's a T. Trillion, trillion, guys. 9.5 trillion, 44% of the GDP. Has to go, basically a little under half of our national GDP annually has already been injected into the markets, equaling $9.5 trillion. That is lunacy. Lunacy. Simply put, that's lunacy. We're halfway in, right? We're halfway through the year. I guess that lines up perfectly. So we got 6 more months to completely wreck our economy. I'm game. I'm game. Obviously, I'm kidding. But this is where we're heading. So if we're $9.5 trillion in and the market has yet to stage a full recovery, that means we're going to need a little bit more, which means we're going to need a little bit more rate cut from the Fed, basically putting us at zero. We're at a quarter basis point right now. So more stimulus is most likely on the way. More rate cuts are basically on the way. And Now, the United States is picking a war with China again by sanctioning top Chinese executives. They're not they haven't done it yet. They're in talks of sanctioning top Chinese. Uh, what was the word? I don't have the thing article, and where they want to sanction top Chinese official. Oh, there you go, officials. Top Chinese officials with involvement in the Hong Kong situation and how that's escalating. So if you've been plugged into that, then you already know how that Hong Kong situation has been going on and escalating. I'm not going to cover it. That's just it's not important to what's going on here. What's important is the sanctions are going to hurt relationships between U.S. China, which hurts the trade relationship, which negatively affects the markets, obviously, and leading perfectly in, that's exactly what we're experiencing right now. So we beat this 200 daily moving average to death, to literal death for the past 3 to possibly even 4 weeks, correct? We beat it to death, and we are here. And we're experiencing rejection. And the funny thing is, I mean, as soon as this market started to dump, because if we go on the 1 hour, it was moving nicely up, right? We had a nice uptrend going here. I mean, we want to see how high this uptrend could continue. And right about when it broke was when they announced that they were looking at sanctioning China. And I went right over to the news and checked to see because the dump was a pretty nice dump coming off of, as you guys remember, I said 3,020 was the number we were looking at, and we missed it by a full quarter. We missed it by a quarter point. Okay, so now I have not gone long on this yet. I do want to see a close of this daily moving average. I'm sorry, the daily candle. I want to see a close of the daily candle, and I want to see honestly one more daily close. So probably I'm gonna wait this out until tomorrow to see what's happening because we have a lot of misdirection going on in the market. I mean, the 3-day chart looks more bullish than bearish. The weekly chart still kind of neutral. I mean, it really depends on this week, which we're only 2 days in, and the daily. I mean, that's not really unless in the next 30 minutes here we see this sucker climb all the way back down to like 29.50, which I doubt will happen. This isn't a very bearish candle. Yes, we're getting a rejection of the 200 moving average, but we want to see solid like bearish confirmation. I want to see a red candle pulling in into the 29.40s with a close for me to go short on this. This is yes, I have been talking about the 200 moving average. Yes, I've been beating it to death. But just because we touched it and rejected it with 20 points of rejection does not mean we go short, right? If I go short here, I'm looking to take a very nice position because this sucker is going to roll over. We're going to roll over and go either for the weekly 200, which is at 26.70 right now, or we're just going to go all the way back down here to double bottom, right? And if that's the case, I want to get a solid position, so we're going to wait it out. More interestingly is gold retesting basically the daily retest. Now, again, this is a very bearish daily candle. Usually when this happens, you open the next one and you get a little bit pushed down. So I'm expecting a solid entry somewhere around 1705 to 1700 on a real touch of the trend line. As you guys can see right now, we've missed it by a hair, right? The wick is there. The wick is here. And X marks the spots right here sitting at 1705. That's basically what I'm looking at. I want to see if we can get there. If we don't, I'll enter at a higher price. It's fine. I don't mind entering 1715. If this was a real retest, we're looking at 1800 anyway. That's a nice $70 move. That's more than enough. All right, so we're looking at how this daily closes in 30 minutes. We should close just about where we are right now, and then how the next daily candle, more specifically how the 4-hour develops. As you guys can see on the 4-hour chart, we're sitting on the 200 moving average on the daily. Okay, so this is looking nice, and depending on the close, again, we want to see what happens. So if we get a close like this, maybe the play is to get in and put a stop loss under the wick. Again, just to see how this develops is basically thing. So also we have I don't want to draw too many trend lines on here, just confuse everyone, but this is basically what you're looking at. If you break this, you go up to 1800. Okay, that's number one. Number two, we're using this as support, and that's a little bit wrong. That's basically we're using that as support. So we're in a falling wedge right now on the 4-hour. Okay, that's gold. Bitcoin, it's not looking as healthy as I would want it to be when we were up here. I know I did say the weekly closed on this weekly bullish, but as you guys can see, the this weekly candle that closed on Sunday pretty much gave all that back, indicating more likely that we are in for a continued downtrend here to about 7,500, 7,600. I would not be surprised. Also, what I am seeing, and I don't know if I talked about this on the channel previously, that we do have an inverse head and shoulders developing on the weekly if and only if we can get a trend of something like this. Would be an inverse head and shoulders pattern on the weekly. So we could go as low as 6,400 on this guy. And realistically, I'm okay with that. I like lower entries on this guy. I'm going to buy everything down. I'm letting you guys know this right now. I'm buying everything I've been buying, and I'm going to continue to buy everything going down on Bitcoin. This is a fool's game to be short looking for 1,100, 3,000, and 5,000 and stuff like that after a halving event where you change the entire dynamics of the market. It is a fool's game to be short here, and I'm willingly, gladly, happily welcome to be wrong on this. I am willing to lose every dollar in my bank account because it just financially wouldn't make sense, right? Now you're thinking it financially wouldn't make sense to lose all your money, right? But knowing what I know, understanding what I understand, Bitcoin's ready for a move higher, guys. Simply put, we do not go through a halving event for this thing to dump, right? Let me clean this up for you guys real quick so I can show you one last thing before we get out of here. Please hit that like button, guys. Please subscribe. It helps the channel a lot. I greatly appreciate it. Leave me a comment. Let me know what you think about the markets. I'm open to any kind of conversation you guys want to have. However, on the smaller time frames now, let me show you guys this. Again, I don't want to draw too many trend lines, confuse everybody, but basically what we're looking at is this. Give me 1 second. So we have a high here that was rejected till we broke out, right? So we're going to take that. We're going to line it up here. And how can we play this? If we play this like this, I like this honestly because this wick and it was held, right? And we put this here like this. We're in an ascending triangle, right? And you can say this is the flagpole. It's not the cleanest of formation, but this is basically a distribution phase for Bitcoin. So we had a massive rally. This was accumulation. We had a rally to distribution. We're not distributing. Now we're trying to figure out, do we go up? Do we go down? And as you guys can see, we're trying to double bottom right under the 200 moving average to push higher. And there's just a lot of confluence here. Bearish, bullish, everything. Very much in a confluence zone here. We have the 3-year trend line. We have moving averages. Everything is kind of converging in one location. So whichever way this breaks, it's going to be a very nice break. Obviously, I do not like it being below the trend line. That is never a good sign and most likely pointing down. So if we break down, our first target's about 70. First target obviously would be 8,000. Okay, but I mean, if we break this, I don't expect 8,000 to hold. So if we break down, we're going to go to 8,000, probably bounce back up to about 8,500, and then eventually end up at 7,500. If 7,500 doesn't hold, our medium term is 6,900, and from there 6,400. Now, if 6,400 doesn't hold, let's not get it twisted. We are going lower. We will go much lower. We will probably go lower than 3,000 and set a new low. Okay, and that's exactly why I do not expect it to break, because after a halving event, guys, supply and demand, very simply, supply and demand. Okay, the supply is now less than the demand. Simply put. And on that, I'm gonna leave you guys. Thank you for watching. Please subscribe, please like, please leave me a comment. Let me know what you guys think. I love hearing your opinions. And until tomorrow, I'll see you guys later.